This is the longest bear market rally we have ever seen in history, if it's a bear market, but a lot of those people are in the bull camp now. In fact, if you look at how many bulls out there, you've convinced even institutions to go on the long side. We're talking hedge funds to go on the long side. They covered their shorts, they've moved out on the long side. My thing is this a bull market starting, or is this part of the psychology of the market chart? If we take a look at the psychology of the market, look at the vertical move from disbelief, which you could make a case was during COVID, right? COVID was disbelief, that huge dump, and the vertical move up in the markets to euphoria, the pullback, and then this move up. Are we in this move up? And again, to be honest, no one knows for sure.
The upcoming Thursday's Consumer Price Index report is expected to show a slight easing in the pace of price increases, although this is unlikely to deter the Federal Reserve from its efforts to combat inflation. Wall Street consensus, gauged by Dow Jones, anticipates a 0.2% monthly increase for July, with a 3.3% 12-month rate. This is significantly lower than the 8.5% rate registered a year ago, just shy of a 4-decade high. Excluding food and energy, the monthly increase is projected to remain at 0.2%, with a 4.8% 12-month rate. While recent data points suggest reduced inflationary pressures compared to 2022, history warns that entrenched inflation can persist longer than expected. The Consumer Price Index has risen nearly 19% since its April 2020 low during the early days of the COVID-19 pandemic. In a related video, macro investor Gareth Soloway discusses a range of economic data, including inflation, loan demand, non-farm payroll figures, and the debt ceiling. He also delves into the implications of the Moody's downgrade on regional banks and examines its impact on Bitcoin.
I do want to show you this one because, again, there's been a lot of talk how early on over the last couple years, inflation, and I even said this, inflation was low in Asia. All right, China wasn't seeing the same sort of inflation we were seeing over here, because over here we eat generally a different diet than those in Asia. What we can see here, folks, is rice in Asia soars to highest levels since 2008. So again, you're starting to see this big move up now into 2023 of rice, which again is an inflationary signal. And what that's going to do is it's going to put more pressure on the Chinese government, more pressure on Japan to be careful and maybe not control that yield curve quite as much. And again, that is something that has to be looked at as a concerning factor. The other thing I want to bring to your attention here as well is this is business demand for bank loans, US versus Europe. To be honest, I don't really care the fact that it's US versus Europe. They're just two separate lines. You have Europe being the light blue, the dark blue being the US. My purpose of showing this to you guys is this. If we look at demand for bank loans, it has fallen off a cliff, okay? And if we look at that and we go back to 2008, we're approaching the same levels as loans demand in 2008, right? So that does have to raise your attention. You have to say, wait a minute, what does that mean? And the reason why this is important is if you look at what causes economic growth, it's money in the system. It's people taking out loans and using that to start businesses and create revenue streams, which then create taxes, which then create more jobs and jobs and jobs and jobs and things like that. And speaking of jobs, the last thing I'll say on this before we get into some chart action is if you looked at the latest jobs report, the non-farm payrolls report that came out, I think it was last Friday or so, what we saw was a gain of 187,000. But if you looked at the underbelly, and this is the big thing, folks, is like, you know, you can put lipstick on a pig, but it's still a pig. And my point here is that if you looked at the underbelly of that economic data that came out, the non-farm payrolls report, you would see that government jobs were a huge gain, but most other sectors, most private sectors were down. They cut jobs. And so again, you could argue that with the US getting this unlimited budget, right, the debt ceiling was raised to unlimited levels, they're now able to spend lots of money, which again goes into the idea of Bidenomics and, you know, just saying, hey, we got to win this election next year. Let's spend. And that's the overall lipstick, right? That's the overall lipstick that we're seeing. But in the underbelly of the economy, in the private sector, things are changing. And again, this is something that raises my alarm bell.
China's imports and exports experienced a more significant decline in July than anticipated, raising concerns about the recovery prospects for the world's second-largest economy. The drop in demand has increased pressure on authorities to introduce fresh stimulus measures to stabilize economic growth. These concerning trade figures highlight the potential for further slowdown in economic activity during the third quarter. Sectors such as construction, manufacturing, and services are all showing weakening indicators, including foreign direct investment and industrial profits. Notably, the pace of export decline recorded in July was the fastest since the beginning of the pandemic in early 2020. Concurrently, the decline in imports was the most substantial since January of the same year, a period marked by COVID-19 related shutdowns of businesses and factories. Gareth Soloway conducted an analysis based on the chart from the 10-year yield China import and export crisis, taking into consideration the Moody's downgrade and its impact. Additionally, he shared insights on Bitcoin, including his price forecast for the cryptocurrency. Let's now return to the video for further details.
This is the 10-year. I want to just do a quick update on the 10-year. We have pulled back off of the highs. Now, interestingly enough, the pullback coinciding with the export and import news from China we got a couple days ago. And again, even Moody's saying, hey, listen, we might have to downgrade the big banks, right? So they downgraded a lot of the regional banks, but Moody's said, we're not going to downgrade the big banks, but they're on watch for a potential downgrade. And what that does is it tells us that even though you would think maybe yields would spike, but especially with the China news, it means that the global economy is weaker, which potentially has a pullback coming in yields because the Fed may have to lower sooner than thought, right? There could be a credit crisis. There could be multiple things that force that yield to the downside. Now, today we're basically flat on the yield. There's not a whole lot going on. Let's take a look at the dollar real quick. The Dixie, the dollar again, a lot of people don't look into this, but the dollar is really, really important. And again, if we zoom out here on this chart, I'll show you guys the level that I've been showing. I mean, I've been talking about this level for a long, long time here. And again, if we just put a trend line in here, we can clearly see that we've kind of come up here and we've retraced to that scene of the crime, right? So if we look at this, we have a clear trend line here. Here, we broke it. Now we've retraced. Right now, notice how the dollar's having a lot of a struggle or a lot of trouble getting back above that level. So if I zoom in, look at how many times it's hit the level and it's still not pushing through. That's because that is major resistance, what we would call a major technical trend line. Now, if it's able to stay here over time, it might be able to push up, which would be honestly a very big negative probably for risk assets, and likely, and this is what we saw, if you look at this move up here, which coincided with that data point from from China, the export-import numbers, anytime there's fear, anytime there's chance of a global crisis, people are still going to run into the US dollar. The US dollar, even with de-dollarization starting and the BRICS countries talking about gold and let's back our currencies by gold, the dollar is still king dollar. That's the essence of it. Now, Bitcoin had a decent day yesterday, and the reason why it had a decent day, and this is your 10-minute chart, by the way, which you can see popping up a little bit, the reason why it had a decent day is because of Moody's. So Moody's, again, downgraded banks yesterday, and basically threatened to downgrade some of the bigger banks. And what we could see is as soon as that downgrade came out, Bitcoin started to pop up. And the reason this happened is the same reason why over here, this is where the bank crisis, where Silicon Valley Bank failed and these other big banks, these other medium regional banks failed, Bitcoin soared, okay? So what we're seeing here is a clear divergence. When you have the stock market selling because of economic woes or anything like that, Bitcoin still is a risk asset that goes down. When you see Bitcoin will go up when we see credit issues. When there's issues in the banks, money flows from the banks into Bitcoin. That is a tremendously positive thing for Bitcoin in the longer term. Now, short term, again, I still think if we hit a recession and we start to see the stock market down 20%, assuming it's not a credit crisis, then I still think Bitcoin goes lower. But if it's a credit crisis, I actually think Bitcoin could end up breaking higher. So watch to see which angle this goes. Credit crisis or just regular run-of-your-mill recession, or maybe both. We'll have to see again how that plays out. But right now, again, you could argue that, again, maybe this is a little bit of a bullish tint to it. This is your trend line to watch. And again, I got to put it a little bit more accurately. I really try to be as accurate as I can on these trend lines. Should be really touching that little low. But basically, this trend line is around 27,700 to 800. If it breaks this, I would be concerned with Bitcoin. As long as it holds above this blue line, I actually think Bitcoin's okay here. I don't have a problem with Bitcoin.
Former Federal Reserve Governor Richard Clarida holds reservations about ending the current cycle of rate hikes that commenced in March 2022, comprising 11 increments totaling 5.25 percentage points. Now serving as the global economic advisor for PIMCO, a prominent asset management firm, Clarita emphasizes that his former colleagues at the Fed should convey a commitment to their ongoing battle against inflation. He advises maintaining flexibility and not prematurely declaring victory. While acknowledging improving macro-level data, Clarita notes that the Fed must avoid appearing disconnected from the evolving situation. The Fed's series of rate hikes seem to have inflicted limited harm, with GDP rebounding from negative growth in the first 2 quarters of 2022 to a robust 4.1% annualized rate in the third quarter, as reported by the Atlanta Fed. However, the American public remains discontented with the state of the economy, evident in President Joe Biden's approval rating of just 39% in the CNBC All-America Economic Survey. This sentiment stems from the fact that the effects of elevated inflation and rate hikes are often acutely felt in microeconomies, particularly among small businesses and household debt levels. Small business owners, who rely on credit card and home equity lending, have faced rising interest rates, leading to potential credit constraints and loan default risks. Looking ahead, if data trends persist favorably, the Fed could consider easing its monetary policy. Recent comments from regional presidents John Williams of New York and Patrick Harker of Philadelphia suggest that an end to rate increases is under consideration. The direction of these developments, whether bullish or bearish, is a subject for discussion, inviting opinions in the comments section. For more daily dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.